Amazon $220 billion spending risk. Will your debt explode? Amazon's $220 billion spending risk urges you to protect your AI capital strategy and secure long-term growth. Amazon's decision to raise its 2026 capital expenditure target to approximately $220 billion should make you question whether bigger AI spending automatically creates stronger businesses, because capital discipline has historically protected companies far better than unchecked infrastructure expansion. When you see Amazon's total debt approaching $129 billion within just 6 months, you should recognize that every aggressive expansion strategy increases financial obligations long before sustainable operating returns begin supporting the balance sheet. Amazon's 20% quarterly sales growth to $200.6 billion certainly demonstrates commercial strength. Yet you should remember that rapid revenue expansion alone has never guaranteed attractive shareholder returns without disciplined capital allocation and consistent cash generation. AWS generated $42.2 billion in quarterly revenue, while operating income reached $16.6 billion. But you should ask whether today's exceptional cloud profitability can permanently offset tomorrow's escalating infrastructure financing costs. Amazon's approximately $169 billion annualized AWS revenue run rate appears impressive, yet history repeatedly shows that every infrastructure boom eventually faces utilization, pricing, or competitive pressures capable of reshaping long-term investment returns. The AWS commercial backlog expanded to roughly $496 billion, suggesting extraordinary enterprise demand. But backlog is not immediate cash because execution delays, customer priorities, and deployment schedules ultimately determine realized revenue over multiple years. Amazon's free cash flow shifted from plus $18.2 billion to $7.6 billion, reminding you that explosive investment frequently compresses liquidity, even while operating businesses continue reporting exceptional commercial momentum. Spending more than $53 billion on capital projects during one quarter demonstrates enormous strategic conviction. Yet history repeatedly proves that the largest investments become the largest mistakes whenever execution falls behind ambitious financial expectations. Property and equipment purchases increased by roughly $66.1 billion year over year, reinforcing that AI competition has become an infrastructure race where balance sheet endurance increasingly matters more than software innovation alone. Andy Jassy explained that new data centers require almost 2 years before meaningful monetization begins, meaning you should expect financing costs, depreciation, maintenance, and energy expenses to arrive long before revenue accelerates. Global hyperscale providers are expected to invest well above $700 billion in AI infrastructure, yet throwing hundreds of billions into data centers cannot eliminate bottlenecks involving electricity, semiconductors, engineering talent, and permitting constraints. You should never assume Amazon's strategy automatically fits your organization because a company generating $200.6 billion in quarterly revenue possesses financial flexibility that most enterprises simply cannot replicate. L-Impact Solutions argues that infrastructure scale alone does not guarantee sustainable returns because businesses creating durable value consistently measure capital productivity, cash conversion, and governance before celebrating expansion milestones. Amazon increased its capital spending target from $200 billion to $220 billion, illustrating how quickly AI competition is escalating. But larger investment commitments simultaneously magnify financing exposure and execution risks across economic cycles. Even with 37% AWS revenue growth and $16.6 billion operating income, Amazon still faces mounting infrastructure obligations, proving that outstanding business performance does not eliminate financial discipline from executive decision-making. NVIDIA's CEO Jensen Huang describes AI as infrastructure. Yet infrastructure historically rewards organizations maintaining utilization above capital costs, rather than those simply constructing the largest facilities regardless of commercial demand. Satya Nadella believes every company will become AI first. But becoming AI first should never mean becoming debt first, because sustainable competitiveness depends upon profitable adoption instead of unlimited infrastructure accumulation. Warren Buffett's principle of protecting capital deserves renewed attention because $129 billion of debt, combined with negative $7.6 billion free cash flow, reminds you that financial resilience always deserves executive attention. L-Impact Solutions encourages you to treat AI infrastructure as a staged investment portfolio where measurable ROI determines each expansion phase instead of allowing market excitement to dictate billion-dollar capital commitments. Organizations should continuously monitor ROIC, IRR, NPV, EBITDA, free cash flow, debt to EBITDA, CLV, CAC, and infrastructure utilization because companies measuring more variables generally identify capital inefficiencies before they become expensive crises. Rather than owning 100% of AI infrastructure, combining hyperscale cloud providers, co-location facilities, hybrid architectures, leased GPU clusters, and managed services may significantly reduce upfront capital exposure while preserving strategic flexibility. Modern AI facilities increasingly consume between 100 megawatts and over 1 gigawatt of electricity, meaning future competitiveness may depend as much upon energy availability as software capability or computational performance. GPU shortages, HBM memory constraints, networking equipment delays, transformers, cooling systems, and semiconductor packaging remain persistent supply chain risks, reminding you that infrastructure projects rarely fail because of software alone. Peter Drucker's principle that measurement drives management perfectly matches today's AI economy because disciplined performance tracking consistently outperforms emotionally driven spending decisions across every capital-intensive technology cycle. L-Impact Solutions believes your infrastructure should expand only after customer demand consistently exceeds available computing capacity, because commercial validation remains a stronger investment signal than competitive headlines or industry hype. Every major AI investment deserves independent governance covering cybersecurity, regulatory compliance, workforce readiness, financial accountability, ethical AI, operational resilience, and measurable commercial outcomes before billions become permanently committed. Before approving multi-billion-dollar infrastructure programs, you should quantify utilization forecasts, pricing assumptions, contract pipelines, power availability, occupancy rates, and projected cash generation because assumptions unsupported by evidence eventually become expensive liabilities. Strong balance sheets require diversified funding, conservative debt maturities, liquidity reserves, revolving credit facilities, and adequate interest coverage because higher interest rates have repeatedly punished businesses relying excessively on aggressive borrowing strategies. Quarterly scenario planning covering AI adoption, inflation, electricity pricing, GPU shortages, cybersecurity threats, labor costs, financing expenses, and regulatory changes helps you respond faster before uncertainty damages enterprise value. Technology refresh cycles typically emerge every 3 to 5 years, making modular infrastructure, standardized hardware, and phased upgrades increasingly essential because yesterday's cutting-edge AI hardware can quickly become tomorrow's depreciating financial burden. Geographic diversification has become a strategic necessity because concentrating AI capacity within limited regions increases exposure to grid failures, extreme weather, water shortages, permitting delays, geopolitical disruptions, and localized labor constraints that can delay billion-dollar projects. AI accelerators, networking hardware, memory technologies, and cooling systems may require modernization every 3 to 5 years, meaning executives must design upgrade pathways today instead of allowing tomorrow's technology obsolescence to erode capital productivity. Independent board oversight should continuously monitor ROIC, infrastructure utilization, EBITDA margin, free cash flow yield, revenue realization, debt maturity profiles, and cybersecurity readiness because governance failures have historically destroyed enterprise value faster than technology failures. Benjamin Graham reminded investors that managing risk matters more than chasing returns, and Amazon's aggressive infrastructure expansion reinforces that disciplined capital preservation remains every board's first responsibility during transformational investment cycles. Amazon's $220 billion infrastructure strategy represents a long-duration capital commitment rather than a short-term AI experiment, proving that future industry leaders will increasingly compete through financial endurance instead of software capabilities alone. Investing approximately $53.1 billion during one quarter demonstrates extraordinary confidence. Yet confidence without flawless execution has repeatedly produced disappointing shareholder outcomes throughout multiple infrastructure booms across modern corporate history. The nearly 2-year monetization gap fundamentally changes AI economics because every data center generates financing costs, depreciation, maintenance, insurance, cybersecurity expenses, and power bills before meaningful revenue begins strengthening operating cash flows. AWS revenue climbed 37% to $42.2 billion. Operating income reached $16.6 billion, and backlog expanded to $496 billion. Yet these impressive numbers still demand disciplined execution before becoming durable shareholder value. Negative free cash flow should never be judged in isolation because Amazon's decline from plus $18.2 billion to $7.6 billion primarily reflects accelerated infrastructure investment rather than weakening commercial demand or operational deterioration. AI competition has shifted beyond algorithms into electricity, advanced semiconductors, fiber networks, cooling systems, engineering talent, and financing capacity, meaning physical infrastructure increasingly determines digital competitiveness across global markets. Industry forecasts suggest major technology companies could issue approximately $250 billion in bonds during 2026, reminding you that AI expansion increasingly depends upon debt markets remaining supportive throughout prolonged investment cycles. With collective AI infrastructure investment projected above $700 billion, capital markets will inevitably reward businesses demonstrating measurable returns instead of those merely announcing increasingly ambitious spending targets every earnings season. L-Impact Solutions believes your organization should copy Amazon's disciplined demand validation, infrastructure governance, and execution quality instead of attempting to imitate spending levels that only a handful of global enterprises can financially sustain. Amazon benefits from approximately $200.6 billion in quarterly revenue and an annualized AWS run rate near $169 billion, advantages that most organizations simply cannot duplicate regardless of AI ambition or executive optimism. Boardrooms should prioritize phased investments, hybrid infrastructure, measurable ROI, and disciplined governance because excessive debt-funded expansion has historically weakened even highly respected organizations during technology transformation cycles. Monitoring ROIC, free cash flow, debt to EBITDA, infrastructure utilization, revenue per GPU cluster, EBITDA margin, customer backlog, and payback period helps transform AI spending from speculation into accountable long-term enterprise strategy. The greatest strategic mistake is neither underinvesting nor overinvesting, but deploying capital before validating commercial demand, because unused infrastructure rapidly converts visionary ambitions into long-lasting financial liabilities. You should remember that every billion invested without verified utilization forecasts, customer commitments, and financing resilience increases the probability that future returns will disappoint despite today's impressive AI headlines and market enthusiasm. Amazon demonstrates remarkable strategic patience, but patience becomes valuable only when infrastructure investments consistently translate into expanding operating margins, stronger cash generation, and sustainable returns on invested capital over multiple business cycles. AI infrastructure should ultimately strengthen competitive advantage rather than simply enlarge corporate balance sheets because investors reward profitable execution far longer than they reward record-breaking capital expenditure announcements. You should challenge every executive presentation celebrating AI investment by asking one uncomfortable question. Where is the measurable commercial demand supporting every additional dollar of infrastructure before debt obligations continue accelerating? Infrastructure readiness increasingly depends upon electricity availability, utility expansion, semiconductor manufacturing, cooling technologies, and engineering capacity, proving that tomorrow's AI winners will solve operational bottlenecks instead of merely developing smarter language models. History repeatedly demonstrates that technology revolutions reward disciplined operators because the dot-com crash of 2000 erased trillions in market value when aggressive capital deployment significantly outpaced sustainable commercial demand and profitability. Historical context beyond the uploaded article. Likewise, the 2008 global financial crisis reinforced that excessive leverage can rapidly amplify strategic mistakes, making liquidity preservation and disciplined debt management indispensable during ambitious long-term investment programs. Historical context beyond the uploaded article. L-Impact Solutions encourages you to view AI as a financial transformation rather than merely a technology upgrade, because sustainable competitive advantage ultimately depends upon disciplined capital allocation, governance, and measurable business outcomes. Amazon's strategy proves that long-term leadership requires patient capital, but patient capital succeeds only when executive teams consistently balance innovation, liquidity, debt obligations, operational excellence, and shareholder expectations throughout every investment phase. You should never confuse infrastructure size with competitive strength because profitable utilization, disciplined governance, customer demand validation, and financial resilience have consistently outperformed unchecked expansion across decades of corporate investment history. Every AI investment deserves continuous reassessment because market demand, financing costs, regulatory expectations, technology life cycles, and competitive dynamics can change dramatically long before infrastructure reaches full commercial utilization. The companies dominating the next decade may not spend the most money, but they will likely convert every infrastructure dollar into stronger revenue, healthier margins, resilient cash flow, and superior returns on invested capital. Amazon's $220 billion commitment should inspire strategic thinking rather than blind imitation, because sustainable AI leadership belongs to organizations combining disciplined execution, financial resilience, commercial validation, and governance before pursuing unprecedented infrastructure expansion. Will your AI spending build wealth or bury you in debt? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.